welcome back to What the Wealthy Do podcast, where we break down the money moves that the wealthy make and show you how to apply those same strategies on your own wealth building journey. I am your host, Stephanie Dorsey. I'm the CEO and co-founder of Margins Capital. Margins Capital is an investment fund that provides women and people of color access to an institutional quality portfolio of alternative investments. Now, today we're going to be talking about one of the most tried and true ways the wealthy build generational wealth, and that is through commercial real estate. I don't know what it is. Black folks, we love us some real estate. That is generally our first foray into investing. And it's probably got something to do with the 40 acres and a mule that we never really got, but that's all right. Because today we're going to talk about how to invest in a way that we create our own 40 acre and a mule opportunity. This is the third episode in our alternative investment series. We've already talked about private equity and we talked about venture capital. Now we're going to talk about commercial real estate. Before we get started, first things first, I want to say Happy Women's History Month, y'all. How y'all doing? And then the second thing I want to say before we get started is, you know the drill. This is financial education and not financial advice. So let's get into it. Okay. All right. So let's start with the basics. Commercial real estate is investing in any property that makes you money, right? And so this is not your personal home. It's also not necessarily your beach house. It's real estate that generates income through tenants, leases, or business operations. And if residential real estate is where people live, then commercial real estate is where the money resides. Anyway, shout out to him. All right, so here are some different types of commercial real estate. So we have apartment complexes, office buildings, shopping centers, warehouses, hotels, medical facilities, and even data centers, as well as self-storage units. So when you're investing in commercial real estate, you're investing in the business of property, right? You're earning returns from rent, appreciation, and sometimes in profit participation. So an example of profit participation is Margins owns a venue. So along with the Hunger Games stage play in London, we own the venue that Hunger Games performs in. So we get to share in the profits from a concession stands as well as the restaurant that is on the real estate. So at its core, commercial real estate is about cash flow and appreciation. And right, so here is the general playbook, right? You buy or invest in a property, and this can be done directly. Either you buy it or you own it, or you work with a group, through a group, y'all get together and y'all buy a piece of property. Or indirectly, you invest through a fund or a syndication. And so a fund is when people pool their money to make multiple investments together, as opposed to a syndication is when people pool their money and they just make one specific investment together. So you buy the property. Then you lease the property to tenants. So if it's a retail space, you will lease your space to businesses. If it's an apartment, complex, you're going to lease the apartments to individuals. Then that asset generates cash flow, right? And so the rent that comes in covers the expenses like the mortgage, the taxes, the insurance, and the maintenance and the costs associated with taking care and operating the property. And then ideally what's left is to generate profit from that. That's your profit, whatever's left after you spend all for your expenses. And then hopefully that real estate asset appreciates in value. And over time, the property's value grows and rents increase and the area further develops around it. And then the last and final step is you exit or you refinance. So either you could hold the property long term and continue to receive the rents, or you could sell it for a gain, or you could refinance it, pull the equity out, and then still retain ownership. And so that's the cycle. And that's what wealthy do. That's what wealthy investors have been doing and repeating for generations. Okay, so now let's break down the different types of commercial real estate, because all properties are not created equal, right? So you have multifamily apartment buildings or townhomes or mixed-use residential properties. So your mixed use is when you have an apartment building and then on the first floor you might have a convenience store store, restaurant on the first floor. And they generally, we're talking about at least 5 doors. They call them doors, or 5 apartments or more. These are considered like the gateway into commercial real estate. And I often, like Michelle, my business partner, and I, she always talks about how she should have bought the townhouse on the Baltimore Harbor. But I think when we bought our townhouses next to each other in Baltimore, we should have bought a building. We should have bought a 4 or 5 unit apartment building. But live and learn, live and learn. So, but anyway, income from these buildings, it all comes from rent from your tenants. The second type of commercial real estate asset is the office buildings, right? So office buildings or business parks. The leases are longer here. They often are 5 to 10 years and they provide a steady cash flow. However, in light of our pandemic and now that folks realize how remote work basically has changed the sector a lot, and you have to evaluate location, tenant quality, and lease terms before you really need to look at those before you decide to invest in an office building. I mean, there are so many ghost towns that are in large metropolitan cities that you just don't want to be in a position where you're holding on an asset like that. Retail is the third type of asset. So think of strip malls or shopping centers. Be careful about malls too, because they too are struggling. But your tenants are going to be things like Starbucks, CVS, grocery store anchors. Those are okay, but actual malls, they're going to struggle. Retail is subject to consumer behavior. And so again, because of how consumers are shopping, the mall is struggling a little bit. Industrial or warehouse buildings are really the quiet powerhouse behind commercial real estate, because unlike malls, they have seen a boom with e-commerce. And so this includes like your distribution centers, your factories, your storage facilities, logistics hubs. And like I said, because of e-commerce boom, this sector has grown tremendously because people need the space to house their inventory. The fifth example or type of commercial real estate fall in your hospitality realm. So those are your hotels, your motels, and the resorts. And the income obviously depends on occupancy and nightly rates. So it can be very cyclical, but when it's good, it's good. The last bucket here, we're going to talk about our specialty assets. And so those are, you think like data centers, senior housing, student housing, car washes, self-storage, or even medical offices. These often have long-term leases and a growing demand. Obviously, as a person whose mother is in memory care, I can attest that senior facilities are, and even like my business partner's mom lives in a senior apartment complex, and it has like a demand list of like 3 years old or whatever. So, but each category has its own risk and reward profile. And so you just really need to be in tune with what is important to you in making these decisions. I've shared this on this podcast before. I had a house that I had a tenant and I did the whole landlord thing. It is certainly not my ministry. I want you to not go through what I went through. And luckily, it wasn't like a terrible thing. I didn't lose my shirt, and it was just more annoyance than anything. And I didn't make money at all. So if you ain't make money, you lost money, but it didn't kill me. But my point is, listening to this podcast, I want you to do some introspection to figure out what of these types of investments sing to you or don't sing to you, and move accordingly.
Hey, it's Stephanie. If you've been listening to this podcast for a while, you know I talk a lot about how the wealthy think about money differently. And one of the biggest differences is how they approach taxes. Most high earners wait until April, file their taxes, and hope for the best. Wealthy people, they plan the October before. They design their income, assets, and giving around the tax code. And the gap between those two different approaches, tens of thousands or hundreds of thousands of dollars every year. That's why I created the High Earner Tax Playbook. It's a course that breaks down the exact strategies wealthy people use to legally pay less, from maxing corporate benefits the right way, to side hustle or business deductions, donor advised funds, tax loss harvesting, and advanced strategies like QSBS for investors and mega backdoor Roth. This is not tax advice. This is tax education. So you can walk into your CPA meeting informed, confident, and strategic. If you are tired of overpaying out of ignorance, check it out. Link is in the show notes below. Now, let's get back to the show.
But here's the truth. Commercial real estate is one of those asset classes that checks off a lot of the boxes that the wealthy really care about. And so cash flow, it comes with regular and predictable income through rents and leases, also appreciation. Property values have grown over time historically in the United States. And so especially when they've been improved upon or they're well located, it can be very, very lucrative. Also the ability for leverage, right? So you can use other people's money to buy an appreciating asset. And that's always a good look. There are tax benefits. Like we all know that the wealthy love a good tax benefit. So you can write off depreciation. You can write off mortgage interest as well as any expenses associated with maintaining the property, assuming for the most part, right, if you're an investor, and there are some limitations, right? But if you're an individual investor doing this and you own the property, these are benefits that you absolutely get to take advantage of. And then there's a thing called a 1031 exchange. So any benefit or any gain you get associated with real estate, if you take that gain, so like for instance, I sold a property, I have a $200,000 gain. Instead of paying the 20% capital gains tax, I could take that $40,000 that I would have to give to the IRS and invest that into a new real estate investment, and I get to kick the can down the road on when I pay back those capital gains taxes. So you like that. And then also people like tangible things, right? Like with real estate, is real. You get to touch it, you get to feel it, you get to see it, you get to engage with it. And so it makes it a psychologically safe and financially stable investment vehicle for these investors, and they like that. All right, so let's break down some basic commercial real estate terms that everyone should know, because I want you to be able to sit in any investment conversation and understand exactly what is being discussed around you. And I say this all the time, you cannot outsource your understanding of this, because you have to make the decision whether or not to invest in this asset class. And so the first term we're going to talk about is net operating income. And so that's the property's income after operating expenses. So all the rents that come in minus the cost to manage the property. It does not include taxes and depreciation and stuff like that. It's literally just what it costs to manage the property. But this number tells you just how profitable a property is. The second term I want you to be aware of is called cap rate or capitalization rate. And it measures the return on investment based on the property income. The formula for determining cap rate is net operating income divided by property value. And the general range is somewhere between 5 and 10%. And the lower the cap rate, the safer the investment. So the higher the cap rate, the more riskier an investment. So if you look at something like an apartment building might have like a 5% cap rate, but then like if you invest in a complete tear down and rebuild of an apartment building and a city, that might have more of a 10% cap rate, because obviously you got to make sure that the rent can justify the cost that you've already expended. Cash on cash return, it measures the annual cash flow compared to how much cash you invested. Then loan to value is also a term that measures the percentage of the property that is financed by debt. So the lower the LTV or loan to value, the safer the deal. So the vacancy rate is the percentage of units or space that's not rented. The lower, obviously, the better. High vacancy kills your cash flow. You want to keep your space rented. So that's the point. REITs or real estate investment trusts are a way to invest in real estate without owning it. So REITs themselves own portfolios of properties, and they pay investors through dividends. And so REITs can be publicly traded or can be privately traded. All right, so if you're listening and you're like, girl, but this sounds cool and all, but how do I get started? Well, okay, it's easy. First, educate yourself. It's important that you learn the basics of commercial real estate deals and how they're structured, because you might end up in a situation like me where you love to, like, where you own a property, and or like there's a gentleman who I just saw on Instagram who said he owned 40 properties and he's cash poor, right? So you want to educate yourself to figure out what makes the most sense for you and your investment style, your lifestyle, and what you want to accomplish, your goal. goals. And then you also need to learn about some of these terms and stuff so that you can figure out how would I even conduct due diligence on some of these deals. The next thing I would do is just kind of start indirectly. If you're brand new but know you want to get into real estate investments, I would look at REITs, and then also they're publicly traded, but also you could look at crowdfunding platforms like Fundrise, or I've had people who have not had great experiences, but I think it just really depends on what you choose on those platforms. And then also you can consider passive investing. So my fund allocates 25% of it to commercial real estate. And admittedly, I am a passive investor. I invest in syndicates that are sponsored by an experienced operator because I don't want to do this. I've experienced it, and I don't want it. But I do believe in it. So those sponsors actively manage the day-to-day. And so when things go left, they get called. I do not get called. I don't want to be called. But if you want to go direct and you're like, no, I got this. I want to do this. I've seen HGTV or whatever. Start small. I would start with a small multi-unit property. I will go into partnership with other investors. Just make sure you hire a good real estate attorney and CPA. Make sure your team is tight because duh. One thing to think about with commercial real estate is just not always, but think long term, right? While you can get into the flipping business, the wealthy generally invest and hold for years, sometimes decades, right? And so think about what it is that you're trying to accomplish and make sure you consider whether or not commercial real estate makes sense for you to accomplish whatever goal you set out for yourself. Because the wealthy, when they are buying commercial properties, they're not just buying assets per se. They're buying income streams, tax advantages, and legacy. And while the barriers to entry used to be really high, technology and new platforms are changing that. And you no longer have to have millions of dollars to get in the game. I mean, you can get in the game as long as you have the knowledge, the patience, and strategy. You can get in the game now for $1, I think you can on Fundrise. Not a recommendation, but I'm just saying access is there. All right, y'all, that is it for today's episode of What the Wealthy Do. Broke down commercial real estate, how it works, the different types, what new investors need to know before diving into the asset, and different terms of art that you need to become familiar with to be conversant in this space. If you found this episode to be helpful, please like and share it with a friend. Don't forget to subscribe on whatever platform that you enjoy your podcast, be it Apple, Spotify, or YouTube. I hope you all have a wonderful, wonderful day and wonderful week, and I will see y'all next week. Bye.